Congress just struck a deal to ban a digital dollar until 2030, and they hid it inside a housing bill of all things. If you're trading crypto, you need to hear this. Stay with me. Hey, what's up everybody? Welcome back to Vishmaster Crypto Daily. I'm your host, and today is June 17th, 2026. We've got a stacked show for you. Congress putting a freeze on the Fed's CBDC ambitions, BitGo throwing EU crypto firms a MiCA lifeline with the July 1st clock ticking, Bitcoin, and the S&P 500 looking a lot uglier when you strip out the money printer, Strategy's preferred stock getting hammered on their latest BTC buy, and the crypto pack machine racking up another big win in Alabama. A lot to get through, let's go. Alright, Washington first, because this one actually matters. The House and the Senate have struck a bicameral deal on something called the 21st Century Road to Housing Act. Yes, a housing bill. And tucked inside it, because this is how Congress works, is a provision that explicitly bars the Federal Reserve from issuing a central bank digital currency until the year 2030. A 4-year moratorium on a digital dollar, written directly into legislation. Now I know what you're thinking. Why is crypto policy living inside a housing bill? Welcome to the sausage factory, folks. You attach your priorities to whatever vehicle is moving, and right now the housing bill is moving. What matters for us is what this actually does. The Fed has been exploring a CBDC for years, and the crypto community has pushed back hard, and rightfully so, because a government-issued digital dollar raises serious questions about financial surveillance, programmable money, and whether Washington uses it to crowd out decentralized alternatives. A ban through 2030 doesn't kill the idea permanently, but it buys the industry 4 critical years to cement its position. And with the political environment being as favorable to crypto right now as it's ever been, there's a real case to be made that by the time 2030 rolls around, the policy conversation looks completely different. Watch for this to clear the floor. If it passes, this is a genuine win. Now let's talk Europe, because July 1st is 2 weeks away, and the pressure is building. That is the hard deadline for crypto exchanges operating across the EU to be MiCA compliant. That's the Markets in Crypto Assets Regulation, or start pulling back from member states where they can't meet the licensing requirements. There have been real, credible concerns about whether some of the bigger players, Binance specifically getting a lot of attention here, can get fully licensed across every EU jurisdiction before the clock runs out. Into that anxiety steps BitGo. They just launched a crypto-as-a-service platform in Europe, and they're operating under BaFin regulation, Germany's financial regulator, one of the most credible and stringent in the entire European Union. The pitch is elegant. If you're a crypto firm without your MiCA ducks in a row, BitGo plugs into your infrastructure and gives you a compliant operating path without requiring you to rebuild everything from scratch. They're essentially offering to be a regulatory wrapper for firms that need one fast. That is a smart, timely business move, and the fact that they went with BaFin as their regulatory anchor gives it real credibility. For traders on this side of the Atlantic, the practical takeaway is this. If you're using European exchange and you haven't checked their MiCA status, do it now. Service disruptions, withdrawal holds, and access restrictions are all possible over the next 2 to 3 weeks for platforms that miss the deadline. Have a backup exchange ready to go. Don't get caught flat-footed. Now here's the story that I genuinely want you to sit with, because it's the kind of thing that flies under the radar, but matters a lot. The CoinDesk ran a piece today with a simple challenge. Forget the price charts. What they did was take both Bitcoin and the S&P 500 and adjust their performance for M2 money supply growth. And the picture gets uncomfortable pretty quickly. What looks like a strong nominal gain in dollar terms starts looking a lot less impressive the moment you account for how much the measuring stick itself has been stretched by money creation. The argument is straightforward. A significant chunk of asset price appreciation across the board, equities, crypto, real estate, has been a function of inflation in the money supply, not actual wealth generation. Now, the bullish counterargument is that Bitcoin is supposed to be the antidote to exactly this dynamic, and over long enough time frames, it has outperformed M2 expansion. But near-term and medium-term, if money supply growth slows or reverses while risk appetite cools, the frothy valuations that have been propped up by liquidity face real pressure. Our fleet was watching this closely yesterday, while our bots were quietly harvesting spread on the BTC-ETH basis trade overnight. The macro analytics desk flagged this M2 divergence as a signal worth monitoring into Q3. Don't let the nominal gains fool you. Do the M2 math. Let's talk strategy. The company formerly known as MicroStrategy, whose preferred stock trades under the ticker STRC, dropped to $91 today. And the reason is genuinely interesting. Strategy announced yet another Bitcoin purchase, which, in theory, sounds bullish for everything tied to them. But STRC investors flinched, and Marcus Thielen at 10x Research spelled out why. The market is starting to price in the risk that the relentless BTC buying is an unsustainable path specifically for the preferred stock. Here is the dynamic you need to understand. STRC is a preferred security that pays a fixed return. Its safety depends on Strategy's balance sheet staying solvent and well-structured. Every time Strategy levers up to buy more Bitcoin at elevated prices, the risk profile of that preferred paper shifts. If Bitcoin sells off hard, Strategy's ability to service its preferred obligations comes into question before common equity holders take their first dollar of pain. So you've got a situation where common equity holders are cheering each new BTC purchase, while preferred holders are getting increasingly uncomfortable with the same exact news. This is a really important distinction for anyone holding any strategy-related paper. A common equity and preferred stock are not the same risk. Know what you own and understand how it behaves differently in a stress scenario. And then there's the political scoreboard. Crypto PACs put $12 million behind Barry Moore in the Alabama GOP Senate primary, and Moore won. He's a Trump loyalist, and this marks one of the biggest single-candidate crypto industry investments in this entire midterm cycle. The industry's political operation has been systematically backing pro-crypto candidates across both parties, and the win rate has been impressive. For traders, the implication is clear. The regulatory environment in the United States is likely to remain favorable well into the next Congress. Every election win like this one is another data point that crypto has genuine, durable political capital. That makes aggressive, restrictive legislation a harder sell in both chambers. Keep an eye on who these PACs back in the general election in November. If Moore holds the seat, that's another reliable vote in the Senate for the industry. Alright, that is your June 17th download. A CBDC ban hiding in a housing bill. BitGo playing Micah savior for EU firms under real-time pressure. The M2 adjusted charts telling a more sobering story than the nominal candles suggest. Strategy's preferred stock repricing the risk of endless BTC accumulation, and the crypto PAC machine keeps delivering results. The overarching theme today is that this market is being shaped by policy and politics as much as by price action. Stay informed, stay ahead. If this was useful, hit subscribe. We do this every single day, and head over to Vishmaster.live for the full suite of tools, signals, and market intelligence. See you tomorrow.